details from the wires, but nonetheless, Shereen, your take.
Well, I just have managed to get my hands on the economic survey. We're still going over the details, but this is what the Chief Economic Advisor, Anantha Nageshwaran, is saying in his second economic survey. He says the economy continues to expand. The Indian economy is on a strong wicket and stable footing, demonstrating resilience in the face of geopolitical changes. High economic growth in FY24 have come on... Sorry, this is, no, ignore this. This is not, this is the older survey that we have managed to get. But what we are getting at this point in time is that the economic survey has been tabled in Parliament, and this is going to potentially project a baseline growth rate of 6.5 to 7% with a potential for an upside. That is what our colleague Sapna Das has been reporting. As we've been suggesting here, this is of course going to be the economic survey that precedes the budget, and in many ways one of course is the growth assumption that the survey factors in, but more importantly it will also set out a path in terms of potential ideas that the government could look at, or priorities that the government could look at, and the expectation is that it will continue to build on the themes that this government has prioritized, which is manufacturing growth, which is focusing on capex, public capex to drive investment, and the expectation is that perhaps on things like technology and AI, the Chief Economic Advisor could present what the government's roadmap could be, and what the government also views as potential concerns when it comes to the fast-scale adoption of artificial intelligence and the impact on jobs. But 6.5 to 7% with a potential for upside is what the expectation is as far as the growth number is concerned. As we get more details, we'll come back to you, but for now, back to you.
Okay, all right, Shereen, thanks very much for that. So yes, all eyes will be in terms of the growth target and what it is put out by in terms of the economic survey, as well as the capex, the current account deficit, the rupee. So they're going to cover all the macros within this. We'll take a short break, but we'll get you more on the markets. We'll keep our eye out on the economic survey. Be back in a jiffy. Stay tuned.
Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for.
Well, you should watch the budget on CNBC-TV18 because we have 25 years of experience
decoding the fine print of the budget in real time. We understand the budget, and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for.
Well, you should watch the budget on CNBC-TV18 because we have 25 years of experience
decoding the fine print of the budget in real time. We understand the budget, and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about
consolidating with a little bit of a negative bias. We have the mid-caps, which are higher at this point in time. But let's talk about specific stocks while we wait by for the economic survey and more details from that. HDFC Bank is in focus. It's up over 2% after beating street expectations. So Abhishek is here with more details on what the street liked about it. Abhishek.
Well, to begin with, the surprise on net interest margin expanding on a sequential basis is perhaps what has worked out, for HDFC Bank in terms of investor reward. So P&L, take a look. The NI and PAT is a beat on our poll. NI is a beat of 0.9% and the PAT is a beat of more than 3%. Net interest margin improved on a sequential basis by 3 basis points. Largely, analysts were expecting a flat net interest margin. Now, other income declined by 41.3% sequentially. Treasury gains were about 7,600 crore in the previous quarter. So that's a one-off that has come in this time around. Operating profits declined by 18.4%. However, if you remove the treasury gains, operating profit grew by 9% on a sequential basis. Provisions were down 80.7% sequentially. PAT declined by nearly 2% on a sequential basis. Asset quality has seen marginal deterioration given the fact that agri portfolio is a seasonal in nature. It deteriorates in Q1 when compared to the Q4 numbers. So gross NPA has increased by 6% on a sequential basis. Net NPA has increased by 17.5% on a sequential basis, suggesting that the provision coverage ratio has declined to 71.2% when compared to 74% in the previous quarter. However, as a ratio, gross NPA ratio and net NPA ratio remain under control for the bank. Back to you.
All right, Abhishek, thanks a lot for that. That's about HDFC Bank, but we can't take our eyes away from the macro data right now, which is coming in terms of the lines from the economic survey. The biggest headline here is that the survey conservatively projects a real GDP growth of 6.5% to 7% with risks evenly balanced. Steady as she goes is what the headline of the economy, the state of the economy is. Let's go back to Shereen. She has more details out there. Shereen.
Well, that is bang on track. That is exactly what our colleague Sapna Das had reported. 6.5% to 7% is the baseline growth rate that the survey is projecting as well. And chapter 1 of the survey, state of the economy, steady as she goes, as you correctly pointed out, Mangalam. That is the headline that the chief economic advisor has attributed to chapter 1. Also, of course, talking about the fact that India has been fairly resilient when we talk about what is happening as far as the global scenario is concerned. If you just were to look at some of the other numbers, inflationary pressures are declining across countries, including here in India. That is what the economic survey is pointing out. The current account deficit is projected to be at about 0.7% of GDP. In fact, the current account registered a surplus in the last quarter of the financial year. Foreign exchange reserves are ample. The environment for foreign direct investment to grow in the coming years is not highly favorable for many reasons. Interest rates in developed countries are much higher than they were during the pre-COVID years, and this not only means a higher cost of funding but also a higher opportunity cost to invest abroad. So that's one of the red flags coming in there as far as FDI is concerned. And if you notice, this is what the data is also suggesting, that we have seen FDI declining in the last few quarters, and that is something that the CA is pointing out as a concern, that the environment for foreign direct investment to grow in the coming years is not highly favorable on account of higher interest rates in developing countries, which will lead to a higher cost of funding, but also higher opportunity cost to invest abroad. Growth, again, as we pointed out, conservatively projecting a real GDP growth of 6.5% to 7% with risks evenly balanced, cognizant of the fact that the market expectations are on the higher side, including, of course, what the RBI is projecting as far as growth estimates are concerned. So certainly much more conservative. That is the economic survey when we talk about the headline growth number that it is assuming. We just need to look at some of the other ideas and the headlines that are coming in from the survey. It is a voluminous document at this point in time. We are perusing the fine print, of course, talking about the election outcome as well. The fact that this is now a third term for the Modi government, but it is a different complexion as far as the government is concerned. And we do have geopolitical uncertainties which are on the rise, which are likely to exert a bigger influence on capital flows, notwithstanding other reasons for preferring to invest in India. Overall, the Indian economy looks forward to FY25 optimistically, anticipating broad-based and inclusive growth. So clearly, as far as growth is concerned, the survey continues to signal confidence, continues to signal optimism. The real GDP in FY24 was 20% higher than its level in FY23. FY20, a feat that was only achieved by very few major economies, also leaving a strong possibility for a robust growth in FY25 and beyond. Growth has been inclusive with a reduction in unemployment and multidimensional poverty and an increase in labor force participation. So the survey is suggesting that there has been an improvement both in terms of a reduction in unemployment as well as labor force participation. And overall, the Indian economy looks poised for a robust FY25, anticipating broad-based and inclusive growth. That's the bottom line there coming in as far as the survey is concerned. Whether there are big-ticket ideas that the survey is prioritizing as possible ideas that the government could take forward, we will have to just peruse the details for that. But let me bring Latha in for a quick check. Latha, fairly conservative there as far as the GDP number is concerned, on the lower side of what most others are projecting.
Oh, absolutely. I think that is the standout feature, that they have not tried to get into the rah-rah idea of, trying to go from 7 to 7.5 when the Reserve Bank, a usually conservative body, is itself standing at 7.2. To desist from that is very important, which means chances are that the budget also will take into account a nominal GDP growth of just about 10 or 11% that the previous, interim budget did. If you're not even assuming a real GDP of 7%, given that the Reserve Bank's forecast is 4.5% for inflation, the overall nominal GDP that they will, and the nominal GDP is important because fiscal deficit is a percentage of nominal GDP, that also is likely to be just about 11 to 12% and therefore pretty conservative. The important paragraph, the outlook paragraph, goes on to say that the Indian growth trajectory is a little better than what it was pre-pandemic. Again, here they are not going into a rah-rah of 8%, which is the average of the last 3 years. Rather, they have said that pre-pandemic, the 10-year average was 6.6, and now we are getting very close to that, and that is why the 6.5 to 7. They point out that the survey points out that there are a lot of positives in the global environment as well, with many advanced economies on the verge of cutting their interest rates. But they go on to say that there is always a geopolitical fear, and then things can get tough even at the global front. Domestic drivers, they are very clear that clean balance sheets of both private sector banks as well as the private sector companies indicates that there is scope for very good investment. And the rainfall, of course, is still expected to be normal. We will have to look for it. Measures like GST and IBC are now mature. So you can't expect outsized gains, and that is why this modest number of 6.5 to 7. That's what the Outlook chapter says.
That is right. Just for the benefit of our viewers, before we bring our guests in, want to highlight 2 quick pieces of information that have come in from the survey. As far as the asset monetization is concerned, and remember, this has been something that the government has been talking about but has underperformed on that front. The National Highways Authority of India has identified and published an indicative list of 33 assets to be monetized in FY25. This will help improve capital allocation by investors while aiding the government in pursuit of fiscal consolidation. That's one. The survey also flagging the concern that many have expressed when it comes to data related to employment. The lack of availability of timely data on the absolute number of formal and informal jobs created at an annual interval, let alone at higher frequencies across sectors, precludes an objective analysis of the labor market situation in the country. So those are 2 important aspects that the survey is highlighting. But let's bring our guests into the conversation. Nikhil Gupta, Chief Economist at Motilal Oswal Financial Services, Satyanandan Shukla, Group Chief Economist at L&T, Kaushik Das, Chief Economist at Deutsche Bank, with us. Gentlemen, thanks very much for joining us. Kaushik, first, the headline growth number assumed by the survey, your take on that?
Hi, Shereen. Good morning. As Latha mentioned, the Ministry of Finance actually has been quite conservative with their forecast, which is, I think, pretty prudent from a fiscal management point of view. And even last year, when they gave the nominal, in the interim budget, when they mentioned the nominal GDP growth for FY25, they just took 10.5% growth, which I felt was on the lower side. So I think they're going a little conservative given the amount of global risks that can suddenly hit you. And they don't want to, come across as too optimistic and then having to revise the growth forecast down. What has happened in the last few years is that whatever growth forecast has been given, we have done better than that, which I think is a better way to approach the fiscal calculations. Markets kind of are sanguine that whatever number the government would give on the fiscal side, they will meet that. Market borrowings will be in line with estimates. So these are all positive things. Only thing is that we should be optimistic about growth going forward because of the capex recovery that is supposed to take place from the private sector side. We've had a increase in private sector capex, but what we are looking for is a broad-based capex recovery from the private sector now that the elections are behind us, and that itself can easily help us get 6.5–7% growth for the foreseeable future.
Yeah, let me bring in Sachidanandan into the conversation as well. Both as far as the growth number is concerned, but also what the survey is pointing out in terms of inflation. Short-term outlook is positive, long-term requires a clear vision. The medium to long-term inflation outlook will be shaped by strengthening of price monitoring mechanisms and market intelligence, as well as focused efforts to increase domestic production. They're talking specifically as far as food items are concerned. But on inflation, believe that the RBI and the government have done a good job. Core inflation declining to a 4-year low. Sachidanandan, both in terms of growth as well as what the Chapter 3 on prices and inflation under control. That's the headline. Your take?
So thank you, Shereen. I think this is a very, very well-reasoned and mature take on growth and inflation from the CEA. And this is very, very reassuring. I think Kaushik already pointed out, typically we see the executive arm being very, very, positive on growth, whereas the central bank typically is a bit more cynical or more reasoned on the growth prospects. With the chief economic advisor now talking about growth being in the 6.5 to 7 corridor, and inflation being around 4.5 or thereabout, which is what every private forecaster is saying, and also the RBI is talking about, I think we are in a well-charted territory. I just wanted to highlight that if you look at the trajectory going forward, the budget is going to be very, very critical and the litmus test. It doesn't need to be either radical nor irresponsible, and it has to be just balanced. And that is what everybody is going to be looking at. In terms of growth, again, I think the thing is, do they come out with some sort of medium-term or long-term vision or strategy? This being the first budget of this coalition government, it is going to be acting as a guidepost for 3 years, typically, before the pre-electoral concerns or the strategy takes over. And therefore, I think if they sound us about how they will make the economy run from here, so far it has been trying to make the economy just resurrect and walk. Now, if they can come up with some strategies on how to make it run and keep this sustainable, I think this augurs very, very well for the economy. Back to you.
Okay, thanks for that, Sachin. But I do want to once again come to the point of the conservative tone that the survey is striking as far as the growth outlook is concerned, and for the benefit of all of you, Nikhil, Samir, Sachin and Kaushik. Just see how the first paragraph of the outlook even starts. The Indian economy recovered swiftly from the pandemic, with its real GDP in FY24 being 20% higher than the pre-COVID FY20 levels. So 20% higher than FY20. This meant a CAGR of 4.6% from FY20, despite a 5.8% decline in FY21 due to the pandemic. Analysis in this chapter shows that the current GDP level is close to the pre-pandemic trajectory in Q4 FY24. During the decade ended FY20, India grew at an average rate of 6.6%, more or less reflecting the long-run growth prospects of the economy. This is the background against which we see the prospects of FY25. So they just taken the long-run average FY10 to FY20, that's 6.6. They've removed the COVID and the post-COVID spurt in growth and simply projecting that 6.6 as the long-run average for the economy. What do you take away from this, Nikhil? Are we likely to see, therefore, a more conservative budget as well, not assuming too much by way of nominal GDP and therefore fiscal deficit? Nikhil.
Hi, Latha. Thank you very much. Okay, so Latha, I think, yes, they are being a little more conservative than what the RBI has forecasted for FY25. But we must understand that be it 6.5% or 7% growth in FY25, it is on a very good base, and 6.5 or 7% does not make too much of a difference in FY25. What matters is, are we going to sustain 6.5 or 7% going forward? As far as the implications for the budget is concerned, I always believe that it's better to be conservative in terms of your receipt estimates and hope for the best, or hope for additional resources during the year, which can help the government to either spend more or be post a better fiscal deficit at the end of the year. So even if we are 6.5 to 7% growth without any fiscal stimulus, I consider it to be a very strong economy after 3 years of 7% or higher growth. I broadly do not see too much need for the budget to be extremely aggressive in terms of its stimulus or the other way around. I still believe, I hope that this budget would be in continuation to what we have seen in the past 5 years. I understand that the government has some extra additional resources this year and they may want to spend it. But principally, I think the broad message should remain the same, that it is going to be a fiscally prudent 5-year period from the fiscal policy perspective, and I hope they continue with that.
Yeah, and that is exactly what we've been reporting as well, Latha, as we heard there, that, the expectation is that this is not to be treated as a new budget. This is to be treated as a continuation of what the government's projections were in the interim budget. What we are given to understand that there's unlikely to be any deviation or departure from the fiscal math, from the fiscal arithmetic that was presented in the budget. But I just want to highlight for our viewers as well as for our guests who are here with us, the growth vision that the economic survey is projecting. 6 areas of priorities that the economic survey talks about. Number 1, boost private sector investment to 35% of GDP through a conducive policy and regulatory environment. Number 2, strengthen India's MSME sector through deregulation at the state and local government levels. Push for sector-specific tailored skilling of MSME entrepreneurs and develop a clear-cut export strategy. My sense is that perhaps we could see something on this front in the budget tomorrow. Number 3, remove growth impediments in the agriculture sector and allow markets to function in the interest of the farmer. Number 4, secure financing of the green transition in India. This has been something that this CEA, particularly Anantha Nageshwaran, has been focused on. Number 5, bridge the education employment gap. And number 6, build state capacity and capability. So the growth strategy for Amrit Kal, as is being highlighted by the economic survey, focuses on 6 priorities, and that is what we'll get our guests to comment on. I would imagine that this is going to be something that we will see being taken forward in the budget in terms of prioritization and perhaps find mention in the finance minister's speech as well. But going back to inflation, Latha, and again, the survey very clearly talking about the fact that prices and inflation are under control. Headline inflation the lowest in FY24. India's inflation is lower than emerging markets. India has one of the lowest average deviations from the inflation target. So building that case that the government and the Reserve Bank have done well on taming inflation, tackling inflation, Latha.
Okay, yeah, I take your point. There is also a detailed paragraph on aviation. I mean, almost a chapter. So we will have to see if there are anything specific coming for that sector. But, this employment education gap to be bridged, the need for financing of green transition, we're probably going to see something on all these. Samir Narang, Shereen read out those 6 strategic areas where they are hoping to concentrate, focus on private investment, boosting private investment, growth and expansion of MSMEs, the potential of agriculture as a future growth engine, the need to secure financing of green transition, education employment gap to be bridged, and focus on state capacity and capability. Now, anything that strikes you as likely in terms of a policy tomorrow, Samir?
So I think one of the things that will be in the budget, which will see a lot of emphasis, would be job creation, manufacturing. Under PLI, we have seen a lot of success in a few key areas. We've seen a large expansion of domestic supply chain in electronics. And I think that will be a focus area in terms of job creation. And I think they're just trying to capture the entire value chain from skilling so that the individuals who are joining the workforce are fairly skilled. And there is an easy introduction of those skilled workforce in the manufacturing sector as demand picks up for this segment in India, as India is becoming part of global value chains. We are also seeing some of this emphasis in terms of apprenticeship in Maharashtra budget as well for younger workforce. So I think there will be some continuity in terms of what we should expect in the union budget. A bigger play would be also on green financing, because India is now looking at power deficits for the next few years, given the power demand that we have seen. So you should see a much larger, expansive program on green financing and achieving our power objectives, as manufacturing intensive growth is more energy intensive than what we've been seeing in the last decade.
That, well, Kaushik and Sachin, just to come back to you all, since it's a very, modest or moderate forecast in terms of growth, do you want to guess anything in terms of fiscal deficit? See, we all know that there is a 1.3 lakh crore of RBI money, which is a one-off. And, that's a different proposition. But there is also an expectation that they can up the tax number for the simple reason that even last year's RE is indicating some 26,000 crores more than what the revised estimates indicated. And if you go by the first 4 months, April-July tax collection, it's standing at about 19%, the overall net tax collection, not even GTR. So, Kaushik, first to you. Do you think that therefore the government will not do anything, ultra spending, considering the modest tone in the survey? You think they'll be fiscally more conservative?
So, Lata, being professional forecasters, we are in the job of, guessing the number. So I'll guess that tomorrow you'll probably get a pretty, nice fiscal deficit consolidation path, and probably the number would be lower than the 5.1 that was indicated in the interim budget. We are going with a 5% baseline expectation, but we think it can be as low as 4.9% of GDP as well, even after the government spends higher than what the interim budget estimate suggested. So given the fact that the government has got more funds from RBI to the tune of 1.3 trillion, plus the FY24 actual budget deficit has been 5.6 compared to 5.8, you could easily go down to 4.95% even after spending some money to boost consumption and with some tax cuts. So I don't think it will be that big a problem, even with a 10.5-11% nominal GDP growth number, which we are assuming in our calculations, and about 70% net market borrowing as a percentage of fiscal deficit. We think that, fiscal deficit could be lower. So we think that there would be some consumption boost, not in any particular item, but over the different items that are there, agriculture to rural welfare, different important components. There would be some increase compared to the interim budget. That would be about 700 to 800 billion INR worth of increase compared to interim budget. But because we have this 1.3 trillion extra funds from RBI, you can still have 400-500 billion reduction in fiscal deficit, which could be to the tune of, and bring fiscal deficit down to 4.9%. So I think it's a very, very good economic survey, kind of guide path towards the budget, with the nominal GDP or real GDP being very realistic numbers. 6.5% to 7% is something which we can believe for this year. Our own forecast is 6.9%, and after that we have assumed a 6.5% real GDP growth for the next 7 to 8 years, and that itself could take India to become a $7 trillion economy, doubling in size, doubling of per capita. So all this structural story remains, and on top of that we are going to have fiscal consolidation, and we can surely reach 4.5% target that has been set for next year, and in fact we can do better than that, is what I would guess.
Well, Kaushik, that's exactly what we've also been picking up on. And of course, all will be revealed tomorrow. But the indication that we get is that there is the likelihood of improving on that fiscal deficit number. And it's very clear that the government intends to stick with the fiscal consolidation roadmap. And they do have that revenue cushion that Lata was also alluding to. But I want to go back to the survey and highlight 2 chapters in particular. Chapter 12 on infrastructure, lifting potential growth. And of course, the survey talks about the fact that public sector investment has played a pivotal pivotal role in funding large-scale infrastructure projects, what they've done on the national highways, what they've done on capital expenditure on railways, aviation, and so on and so forth. But here are the new ideas that the survey is throwing up as far as infrastructure is concerned. And I'm quoting from the survey: given that infrastructure creation efforts in India are currently predominantly public sector led, a higher level of private sector financing and resource mobilization from new sources will be crucial for India to continue down the path of building quality infrastructure. Facilitating this will require policy and institutional support from the central government, also state and local governments. Also, existing databases fall short on assessing the demand for infrastructure and tracking the utilization of facilities. The construction of an index that tracks the utilization rates would shed light on subsectors where there is either an oversupply or a shortfall. Nikhil, to you first. On the government capex side, industry bodies have basically asked the government to do a higher capex than what was provisioned for as far as the interim budget is concerned. Do you see that as a possibility? Do you believe that the budget is likely to take that forward? And what do you make of what the survey is highlighting on resource mobilization from new sources, Nikhil?
Yes, so Shereen, the government had budgeted 11.1 trillion rupees as total capital spending in the interim budget, which implies a 17% growth over FY24. 17% growth after 3 consecutive years of 30% plus growth on an average, which is a very, very good number according to me. But what matters again, this is something that we have highlighted again and again, that center's capex is only one part of the entire budget capex. There is something called internal and external budgetary resources, which means simply the capex done by the CPSEs, the companies owned by the central government. And we have seen capex, CPSEs capex declining massively in the last 3 to 4 years. So what matters from the economy perspective is the combined capex of the central government and the CPSEs. And if you look at the combined budget, combined capex of these two entities, central government and the CPSEs, it was 3.6% of GDP last year. It is budgeted at 3.6% of GDP for FY25, which is actually slightly lower than what it was in the pre-pandemic years, which was close to 3.8% of GDP or so. So the central government is doing whatever it can to boost the capex in the country. But again, we must understand that central government is only one participant in overall investment story. The corporate sector, the household sector are much, much bigger investors in the country. And I think you mentioned that the economic survey mentions that they want the private sector capex to go up to 35% of GDP. Did I hear it correctly?
Yes. That's right.
So that's private sector. Right. They're talking about private investments, which means if you add another 5% capex by the center and state governments, they're talking about 40% investment to GDP ratio, which we have never seen. Of course, I need to go into the details and understand clearly what they are talking about. But if we want that kind of capex or investment to GDP ratio in the country, then we must be very clear about the financing of this investment as well. Otherwise, as we have seen in the historical episodes as well, higher investment to GDP ratio leads to worsening the external balances, which means we will not be able to sustain higher investment to GDP ratio. So that is something that we need to keep in mind whenever we talk about investment recovery in the economy.
No, that's a fair point that you make, and you're absolutely right in pointing out that we have seen those record numbers coming in as far as government capex is concerned. But I want to go back again to Chapter 11, which really talks about the contribution of the services sector, accounting for about 55% of the total size of the economy in FY24, estimated to have grown by 7.6%. But here's again what the survey is throwing up, and I imagine that in some form or fashion we are likely to hear the finance minister allude to this. The emerging jobs demand in the services sector entail greater and more focused skills. Focus areas should include blockchain, artificial intelligence, machine learning, Internet of Things, cybersecurity, cloud computing, big data analytics, augmented reality, virtual reality, 3D printing, and web and mobile development. Remember, even in the interim budget, we did hear the finance minister talk about AI. Of course, the government has also articulated an AI roadmap, but the survey also now talking about the fact that job creation will also need to be matched with the requisite skills development, and focusing on these areas. Upskilling through government and industry collaboration can enable India to become a high-value partner in areas like cybersecurity, enterprise management, and other specialized areas. Samir, both on infrastructure as well as services, some of the highlights that we just pointed out.
So I think, Shereen, on the infrastructure side, even the last survey spoke about NAFID as a key agency which can fund a large infrastructure trust in the country. Earlier, we used to have infrastructure development financing agencies, but that model was given up, and then we had some of those agencies being converted into banks. I think we've again reshifted the model back to certain key trust infrastructure financing agencies led by NAFID. And I think that could be one of the areas which can, look at funding through both global, going into global markets and taking the requisite resources, as well as monetization of a number of projects which are actually generating cash flows. So there could be two-pronged strategies in terms of funding. On the skilling and services side, I think there would be a broad focus on tertiary education in terms of skill development, wherein we focus on right skills so that the candidates that are coming out of our education system are actually job-oriented and can get into the workforce much more easily. We do hear these discussions coming from corporate sector that the candidates are not skill ready, they need to be trained for 2 years or 18 months. I think that bridging of gap, but perhaps the budget will look at over the next 4 to 5 years, how the other Southeast Asian countries have bridged that gap through apprenticeship. There could be a broader thrust towards that area as we move ahead in the next 4 to 5 years.
Okay, thanks for that, Samir. Sachin, would you want to add, in the infrastructure chapter, the conclusions only show that the survey is asking for all databases to be integrated. The point the CEA is making is that, the central government spend, the state government spend by the various, NBFCs, banks and other entities. There isn't any consolidated base available, but they're not talking about new ways of raising money. I was hoping that because there is this, bond index inclusion and therefore more debt money coming in, maybe something about capital market development for infrastructure would be in the cards, but there is nothing like that in infrastructure. From a capex point of view, how would you read this fairly modest, explanation on infrastructure? No brave ideas.
Latha, I think we need to work with the resources at our disposal much better. I think there is a bit of slack in the way we do things. I think what is very heartening is to hear that they're talking about a 35% to GDP as the capex ratio. I think there is some confusion. Nikhil said it's only private, but I'm assuming it is the overall capex to GDP number that they're talking about. And there, Latha, I think we have this issue between in terms of the absorptive capacity of the center and the states. For example, F24, the central government was able to spend nearly 99% of the capex target, whereas the state governments put together, by and large, the larger states put together were able to spend only 80-81%. So I think we have enough mechanisms, we have enough agencies. So capital definitely is not an issue. We need to be working a lot more on the absorptive capacity of the administrative machinery. We need more coordination between the center and the states and between the various agencies. And I'm sure once we do that, we'll be able to really move forward. Another point, Latha, that I wanted to make is that it's very heartening to see the way the fiscal consolidation is happening. This year, we've seen a hand of God via the RBI dividend. Governor Das and RBI have handed out a bonanza to the government. But typically, if you see the way we have done or gone about fiscal consolidation is via compressing expenditure. We are in a positive phase where we are actually doing fiscal consolidation via the revenue side. And this is a good space to be in. If this continues, and you did mention about how they've been conservative on the numbers, I think the motto is that promise and over deliver, and I think we will really do well to first align on the data bits. There are massive gaps. We need to look at the utilization levels and also the absorptive capacity. And I think we are in a happy space.
Okay. Well, actually, I'm trying to read only the conclusion paragraphs of all the chapters of the 6 thrust areas that Shereen earlier spoke about. There aren't any new ideas that the CEA is trying to project. Maybe the medium-term growth outlook is the only chapter where perhaps something new may come. So let me just wind up this conversation by asking you all, going by the meager leads we have from the economic survey, what you guys are expecting by way of fiscal deficit. We know that the government has about 1.7 trillion more, 1.5 to 2 trillion more to spend in the current year compared to the interim budget estimates, 1.3 from RBI and maybe another, half a trillion from higher taxes. So what are you all expecting in terms of welfare, capex, fiscal deficit? Will it be equally distributed or will it be a giant two fiscal deficit? Samir, you go first. As brief as possible, we want to wind this up.
No, sure, Lata. So I think, first of all, we believe the extra personal income tax may not happen because some of that will be given away in terms of change in standard deduction or slabs. So the remaining, which is 1.3 trillion, which you said is coming from the RBI dividend, will be split with 30,000 odd crore higher capex. Remaining would be higher revex. And revex will be mostly in terms of welfare spending towards key areas such as healthcare, such as education.
Got it. And no change in fiscal deficit.
No, we have marginally tweaked it lower by 10,000 crore, no change, 5.1%. As you clearly said, it's continuity.
Okay. Sachin, yours? I just want
no
3 sentences on each of them.
Right. No change in the fiscal deficit. I think they will try and distribute some money towards the needy pockets and segments of the economy, and at the same time, up the capex number a bit.
Up the capex number. Okay. Nikhil?
20 to 30% towards further reduction in fiscal deficit. Capex, if you include anything towards job creation in capex, then 15 to 20% capex, and then the remaining for the welfare or revenue.
Okay, so basically one third you're expecting. So maybe a 5% fiscal deficit is what you're going with. Kaushik, you said 4.9 fiscal.
Yeah, I think I'm the most optimistic. My base case is 5, but I think my heart says it can go down to 4.9. Out of the 1.3 trillion extra, I think 80,000 crore would be spent on revenue expenditure. Capital expenditure, 11.1 trillion. It's quite a lot to spend within the 8 months that is there in this fiscal year after the budget and all. So I think mostly it's revenue expenditure, but you still have 50,000 crore then savings in fiscal deficit. As a percentage of GDP, you can easily go down to 5% or even lower. I hope it happens tomorrow. And then India would be set for a ratings upgrade sometime soon.
Oh, rating upgrade. That will be great, of course. Gentlemen, thank you very much. I'm giving you time to look up the economic survey. Sorry, Shereen?
No, I was saying that ratings upgrade has been much anticipated, Lata, and I think all eyes will be on whether that finally transpires or not. But, just the point that all of our guests were making, and this is what the survey highlights, that the fiscal balances of the general government have improved progressively despite expansionary public investment, tax compliance gain driven by procedural reforms, expenditure restraint, and increasing digitization have helped India achieve this fine balance. So it tells you that there is elbow room for the government should it choose to act at this point in time. And remember, while there is an element of continuity, and that seems to be the message that the government is sending out, this is also for the very first time in 10 years, a coalition, a true coalition government. You've already seen Andhra Pradesh put down very specific asks in terms of the expectations that they have from the government, from the finance minister. And just yesterday at that parliamentary meeting, the JDU also talking about the need for Bihar. Of course, none of that, at least it's in the many pages that we've gone over so far, found mention in the survey, but we will, of course, have to look at this more closely. But that is certainly going to be something that we will have to factor in as well when the finance minister rises to present her 7th budget, of course, creating history with that 7th consecutive budget as well. So, gentlemen, finally, before we let you go, of what we've seen so far, the survey put out, and Kaushik, I'll start by asking you, the expectation is that perhaps a little bit more on capex, perhaps a little bit less as far as the fiscal deficit number is concerned, but on tax, and the hope and the expectation is that this could be the budget that the taxpayer will be provided some sweetener. Is that your expectation? Is that your best case scenario as well?
Shane, everybody wants a tax cut. It's nice to have a tax cut. I hope they cut taxes and then you can manage expenditure as well. But let's see, if there are some tax cuts, it will only be at the margin. So I'm not going to, assume a big tax cut as such for everybody. And even if there's a tax cut, I don't think the government will show any reduction in revenues, because they'll assume that part of that extra money that people will have would be consumed, and then you'll get that money back through higher GST and indirect taxes. So I would assume some bit of tax cut on the lower margin, but that would not lead to a reduction in revenues as such. So we can still manage 5% fiscal deficit or lower, along with some tax cuts and higher expenditure out of the bounty that the government has got from the RBI.
Sachi, Kaushik, they're alluding to the fact that there is an expectation that there could be some sweeteners on the tax front. But what about something that could perhaps potentially sour sentiment, and that is the possibility of higher taxes? We don't know whether they will touch capital gains and review the regime in any form or fashion at this point in time. But what we've heard from the two regulators, SEBI and the RBI, over the weekend, potentially, any higher taxes, especially as far as the F&O side is concerned, what would the expectation be?
Shereen, I think there is some scope for the government to really provide something to really nudge them on the new tax regime side. But this does call for some sort of sweetener from the government, and that's probably the only thing that would come about. I do not hope that anything comes on the capital gain side. As far as F&O goes, Shereen, when you have the SEBI, when you have the regulators looking at something like that, I don't see why the budget should be really coming with some measures trying to contain some irrational exuberance over there. So I think the SEBI is fully empowered and it has a lot of tools to really do whatever is needed. So I again don't really think that the fiscal policy or the budget especially should be doing something to address that.
Okay. Well, that may well be the case because STT is anyway a minor tax. But Sachin and other economists, please stay on. Shereen, there is one important paragraph which you all might find very interesting. This is actually the chapter on farmers and farm-friendly policies. But it goes on to say whether one of the ways in which to help the farmer is by re-examining, guess what, the inflation targeting framework. The point the CEA is making is that very often the Reserve Bank goes after inflation when it is food price induced, as in the current situation. And that hurts the farmers' interest because that is the only time they are making money, since most of our farm price increases are supply induced. Not my words, the words of the CEA. So he is asking the question whether the inflation targeting framework should be re-examined to exclude food and make the MPC target something excluding food. I'll read the lines so that I'm not misquoting. Food constitutes a very high portion of the CPI. This is par for the cause. Hence, when central banks in developing countries target headline inflation, they effectively target food prices. So when food prices rise, inflation targets come under threat. The central bank appeals to the government to bring down prices. Okay, let me come to the operational word. Deploying these tools to deal with inflation caused by supply constraints may be counterproductive. Therefore, and watch this, it is worth exploring whether India's inflation targeting framework should target inflation rate excluding food. Hardships caused by higher food prices for poor and low-income consumers can be handled through direct benefit transfers. So this is a very big thing, especially because now the 4-year term of the external members ends. So, last time there was a relook at the inflation targeting framework at that time. And of course, for all you know, Governor and Dr. Patra also could end their terms. They could be extended. We don't know. But, is the CEA indicating that there could be a review of the inflation targeting framework? Well, to you first, Kaushik.
Yeah, Latha, this is a very interesting debate. And I remember that last time this was relooked, I was of the opinion that India should have a some weight given to core inflation, and you cannot just do inflation targeting based on headline, and which is basically a reflection of food, because ultimately then what you end up doing is reacting to tomato prices and onion prices, and that is 50% of the food basket. So I think you should not make inflation targeting just based on core inflation in India. That has its own negatives, but you should give some bit of weight to core apart from looking at headline and then take a call overall whether to reduce rates or not. As of now, RBI has to target headline inflation as per the rule, and that kind of binds them into a very difficult position at times, and they're not able to ease even when core inflation is at a record low. So to that extent, I think some bit of flexibility on looking at both core and headline can help, because end of the day, I mean, all these vegetable prices are not in the control of RBI, and all you can hope is some government support. Once the vegetable prices go up, then they can take some steps. But in order to get proper monetary policy kind of reaction function, it has to be based on core inflation at the end of the day, because that is what matters most, and that is what the central bank can actually affect. Now we understand inflation expectations play a big role in RBI's thought process, and food prices kind of determine that inflation expectations. But that's why I'm saying it cannot be just core inflation like some advanced countries. It should be a mix of both core and headline is what I would recommend once the next time they're looking into this framework.
Gentlemen, we're also joined by Suman Bery, the Vice Chairman of the Niti Aayog. We'll get to him in just a second, but we were just discussing this, and one of our guests pointed out that perhaps the budget may not be the appropriate mechanism to address this issue of what is happening in the stock markets, and something that both regulators have alluded to. Here is what the CEA, the Chief Economic Advisor, is saying when it comes to retail investors rushing into the stock markets. It says the financialization of economies has not ended well, even for advanced economies. The global financial crisis of 2008 is an obvious example. Developing countries face debilitating crises when financial market innovations and growth run ahead of the economic growth. Goes on to say there is a significant rise in retail investors in the stock market, which calls for careful consideration, possibility of overconfidence leading to speculation and expectation of greater returns. The financial sector should expand at a pace that is in lockstep with economic growth. India can ill afford economies over financialization at this current development stage. Let me welcome to the program the Vice Chairman of the Niti Aayog, Mr. Suman Bery. Mr. Bery, many thanks for joining us. We wanted to talk to you about the growth assumption that the survey makes, but let me get you to address what we've just pointed out, something that the survey has highlighted, something that we've had both the Reserve Bank Governor as well as the SEBI Chief also allude to over the weekend. Significant rise in retail investors in stock market calls for careful consideration. Possibility of overconfidence is leading to speculation and expectation of greater returns. The financial sector should expand at a pace that is in lockstep with economic growth. India can ill afford economies over financialization at its current development stage. What do you make of what the survey is saying, particularly on this front, Mr. Bery? And would you expect that we could then perhaps see some measures being brought in to cool things down?
Shereen, these were matters on which I used to take an interest, but they're not part of my current responsibilities at Niti Aayog. But just as a development economist, a few reactions, if I may. First, India has a much lower credit to GDP ratio than other countries, certainly China. And so I think gradual increase in financialization is a reasonable prospect. And how to create safe assets and how to make sure that the casino dimensions of markets don't overwhelm their resource allocation role. That is certainly what the joint actions of the RBI and SEBI are directed to, and I think we've been doing it fairly well. I would make one point, which is that, having been around at the RBI at the time when we abolished the control of capital issues and started opening up equity markets, we opened up equity markets but not debt markets to foreigners on the ground that they would bring discipline, and when they exited, if they exited in a rush, they would bear capital losses. What is happening at the moment, and I think this is the thing we need to prepare for, is that even as foreign investors, portfolio investors, head for the exits, now there are a lot of domestic investors, so as it were, the impact is not showing up on equity prices. And so there is a risk that less experienced, less professional investors will be left, as it were, carrying the can as the more experienced investors exit. So, briefly, we must aim for greater financialization of the economy, because otherwise, coming to something that the economic survey in Chapter 5 does talk about, we are not going to have the depth to finance our increased investment requirements, and that is going to have to come domestically. So that's a good, not a bad. India could, in time, even be a provider of financial services to the world if the world becomes safer. But there are short-term issues that the regulators need to keep track of.
Yeah, Dr. Bery, thank you very much for that. I nevertheless want to add to what Shereen has said about the stock market. Shereen, actually in page 64 of the report on financialization of markets, the CEA goes on to say that India's market capitalization has seen a remarkable surge, and market capitalization to GDP ratio is now surpassing that of other emerging market economies like China and Brazil. And that's where he says, and I'm quoting from the report, it is essential to strike a note of caution. The market capitalization to GDP ratio is not necessarily a sign of economic advancement or sophistication. Financial assets are claims on real goods and services. If equity market claims on the real economy are excessively high, it is a harbinger of market instability rather than market resilience. Now, this is not really going to FNO. He's only talking about the stock market, the cash market surge. And even over there, he's pointing to instability. And then, of course, goes on to retail participation, not just through mutual funds, but also outside the mutual funds. I just thought I'll add to what you pointed out.
No, absolutely. But let me bring Mr. Bery back into the conversation. Mr. Bery, let's talk about what the survey now suggests as far as growth is concerned. And by all accounts, on the lower side of what other private forecasters are forecasting at 6.5% to 7%. And the 6 priority areas that the survey has highlighted, which the government as well as the private sector need to focus on in order for us to be able to get that sustainable 7% plus kind of growth rate to achieve the Amrit Kal objectives. Your take on the growth roadmap as well as the fiscal roadmap that the survey alludes to?
Yes. First, the survey coincides with our findings at Niti Aayog, which is that for at least the last couple of decades, we have ups and downs. We have maintained a long-term average growth rate of 6% already. And that is, I think, very impressive and speaks to a maturity of institutions and maturity of a decision-making structure. Now, the question or the distinction I want to draw for your audience is between the 6 or 7% that you and your earlier commentators were talking about for the coming year and the kind of growth that we are concerned about and thinking about Viksit Bharat. Broadly speaking, short-term cyclical fluctuations are driven by by short-term demand, including demand from abroad, exports, and what have you. But when you have 6% sustained growth over 20 years and more, I'm talking about pre-COVID, obviously, this reflects developments on the supply side, and more detailed work that has been done by the RBI and I think by the World Bank as well suggests that actually it's been a reasonably healthy growth story, with productivity increase playing quite an important part. Indeed, when I was chief economist of Shell and I looked at India, amongst other countries, the thing that struck me is that India is a pretty balanced economy. We don't have, except for one area, fiscal, which you raised, and which I'll come to, namely that we don't have large current account deficits. As the economic survey notes, our growth inflation trade-off has in recent years been better than the pack. So the point I'm making is that in the issues that arise in Chapter 5, which is financing longer term investment, largely domestically, what is it that we need to change, or what is it that needs to change on the macro side, quite apart from the micro issues that the survey raises. So, I think 7%, I would say that the overall tone of the survey is commendably balanced, sober. It's not a rah-rah document, and I don't think it has been for the last couple of years, but still, we see ourselves as aspiring to becoming an advanced economy in the next 25 years, and so the questions are, what does that take on the supply side? And I think we'll get some answers to that in the budget tomorrow. I hope that the budget will pick up on some of the themes of the economic survey, which I think are very well chosen and very succinctly put.
Okay. Dr. Bery, I just wanted to ask your own view, or Niti's view as a macroeconomist. The survey is only looking at 6.5 to 7, and they actually point out that FY10 to FY20, that is pre-COVID, the average has been 6.6, and that is why they are looking at 6.5 to 7. Do you think they're being too conservative? Do you think that it would be better? RBI's estimate is 7.2 for the current year. Do you think that you would have given a higher target or a higher forecast?
As I say, enough people, including those people on your panel, follow these, as it were, cyclical things. So I think the underlying question is, longer term, can we aim to up the 6.5 to 8? And what would that take? And there are discussions of that in the economic survey, with which I agree. A lot of it has to do with energizing the MSME sector, having a skill development agenda which is more impactful, remediating some of the shortages of skills and human capital in our university graduates. Look, I mean, the fundamental is very clear. this is an Amrit Kal because of our labor force, our demographic dividend. India's essential asset are its human resources, as was the case with Korea, to some extent was the case with China. And the question is do we have a machinery that is able to get the most out of these human resources at rising levels of productivity? A lot of that labor is, I wouldn't say trapped in agriculture. Indeed, it's now the case that for rural households, agricultural income is a smaller part of their income. But the fact of the matter is there are productivity gains to be unleashed if our human resources, both current and prospective, can be better matched to new opportunities. That's the long game, and if we get it right in a more complicated world, I do think that we can aim for more than our historical 6.5, 7. So another way of putting it is all that is happening geopolitically around the world a reason to lower our domestic ambitions? And my answer would be, I don't think so.
Well, speaking of, what is happening globally, and here's an interesting take from the economic survey, Dr. Bery, and I wanted to get your comments on that, on dealing with China. And the survey is essentially calling for a review of India's strategy on FDI from China. In fact, it says, will China +1 result in total movement of trading relations away from China? This may not be the case. Take, for example, nations like Mexico, Vietnam, Taiwan, and Korea, who've been direct beneficiaries of US's trade diversion from China. It says India faces two choices to benefit from China +1. It can integrate into China's supply chain or promote FDI from China. Among these choices, focusing on FDI from China seems more promising for boosting India's exports to the US, similar to how the East Asian economies did in the past. Chinese companies invest in India and then export the product to these markets rather than importing from China, adding minimal value and then re-exporting them. Your view, Dr. Bery, on the call for a review as far as the China strategy is concerned?
Well, we share a common border, unfortunately a contested border, with the second largest economy in the world. Okay? Mexico shares a border with the largest economy in the world. Now, it is certainly unfortunate that for reasons that we have no control over, that there are diplomatic issues with China. And it is unfortunately also the case that some of these, if you like, disagreements have arisen because of the very large economic gap that has opened up between us and China. The question now is, and it's an important question, it's a question even the great United States is grappling with, how is it that you benefit from being a neighbor to a technologically sophisticated and substantial market on your border without losing strategic autonomy? I think it can be done. This may not be the best time to do so, but I think over the longer run, one should be looking to a future where the Indian and Chinese economies are perhaps even more integrated than they are, noting the fact that after the US, I think I'm right, China remains our second largest trading partner. And the question is, I know NITI has not explored what it would mean to de-link ourselves from China to demote its status amongst our trading partners. I think I just happened to glance briefly at the economic survey, but if I heard you right, there is a concern about being part of value chains that end up in China. I think that's a reasonable concern, and I think that that was one reason why India chose to go a different direction of higher domestic value added and not being part of global value chains. And I think this was probably also one, although not the only reason, why we chose finally to back away from the RCEP agreement when we did. However, let me point out make two other points if we're not out of time. First, let us be clear that our services sector is already a very important part of global value chains. The so-called global capability centers, the GCCs, what is that other than being a part of a global value chain? And let me also say that both with Prime Minister Modi's visit to the US, the state visit in 2023, and the External Affairs Minister's very energetic diplomacy with Europe, with the creation of IMEC, that there are value chains directed to the West that we should be exploring and making sure that our domestic policies and our domestic lobbies, to be honest, don't prevent us from being part of those value chains.
Fair point. I think that is what the survey is suggesting as well. But Dr. Bery, before we let you go, at this point in time, we will of course know what the fine print of the budget looks like tomorrow. But is there a case to your mind that there be a higher number as far as private capex is concerned over what the interim budget had suggested? Is there a case to do more to provide sweeteners to the salaried class by way of tax SOPs? I just want to understand from you where you believe there is a legitimate case for the government to spend some of the additional fiscal cushion that it is now provided with.
Shereen, my only response to that, I mean, I am a taxpayer and I have a vested interest, but I would just say that firstly, I mean, they talk of a review of our policy towards China. For a long time, review of our direct tax code has been pending. And what better time than the start of a fresh administration, a new government? Because I think the compliance dimensions of our tax code are very, and not to mention the GST as well, these are high burdens compliance, not just the incidents, on our MSME sector. So if, as the survey rightly argues, jobs are to come from the private sector, and much of our private sector is in the MSME area, I think simplifying the tax code is frankly more important than giving away SOPs, although I know that will be all of the attention in the pink papers when once the budget has been presented. And there was a direction of change, and I think it hasn't, which is that indirect taxes are regressive. Direct taxes, if paid, are a way of getting progressivity. And so if we can return to a steady path of on the whole, with higher tax ratios, moving from indirect to direct, I think that's the direction in which policy should move.
All right, Dr. Bery, we will leave it there. Appreciate you joining us here today to help us make sense of the economic survey. We look forward to speaking with you tomorrow when the Finance Minister presents her 7th consecutive budget. Appreciate you joining us here on CNBC TV18. That is the Vice Chairman of the Niti Aayog, Dr. Suman Bery. Well, a quick check as far as the markets are concerned. At this point in time, you've got the Sensex down by over 100 points, 109 points, and the Nifty Bank is just flat at the moment. We are going to take a break and return with the market coverage and more analysis of the economic survey. Don't go anywhere. We're back in a moment. Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for.
Well, you should watch the budget on CNBC TV18 because we have 25 years of experience
decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for.
Well, you should watch the budget on CNBC TV18 because we have 25 years of experience
decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for.
Well, you should watch the budget on CNBC TV18 because we have 25 years of experience
decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for.
Well, you should watch the budget on CNBC TV18 because we have 25 years of experience
decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but The big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for.
Well, you should watch the budget on CNBC-TV18 because we have 25 years of experience
Decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for.
Well, you should watch the budget on CNBC-TV18 because we have 25 years of experience
Decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for.
Well, you should watch the budget on CNBC-TV18 because we have 25 years of experience
Decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but
Good afternoon, welcome to
big
Midcap
question on
Radar and
everyone's
Twitter
mind,
with me is
will a
Vivek Iyer. For the
240-seat
markets, it's a day of
mandate
consolidation. We
reframe
did
the
see
priorities
a massive
of the
recovery
union
from the
budget?
lows, from
Will
the
there be more
close,
sweeteners
from the
for the
starting
middle class?
lows,
Will
but
there be
from
more
then
put
we
on
have
the
fallen a
table
bit.
for welfare
The Nifty
schemes? How
absolutely
will the
flat with
government
some
boost
negative bias.
consumption?
It's down
Those
15
will be
points.
some of
The
the key
Sensex is
things.
also flat. Midcaps are flying today after that decline that we saw in last two trading sessions. So that index is up around 800 points, but Bank Nifty is the one which is in the green but underperforming the benchmarks. But again, as I said, all the action in the mid-cap index, Vivek.
All the action in the mid-cap index, and like you mentioned, the opening dip was bought into quite significantly, and the Friday lows and the Friday fear that we saw is something that's not being replicated today. Quite a lot on our show lined up. First up, this is our special segment, Mid-Cap Movers, where we have Hormuz to take us to the mid-caps that are moving in the session.
Some bit of rebound coming in within the broader markets after the fall that we saw across Thursday and Friday. So good going there, but can't say the same for the benchmark indices, being a little bit on the edge ahead of the budget announcement tomorrow. But some earnings reactions, there are plenty of them. So Indian Hotels, the top gainer on the mid-cap index right now, 8% higher after its results. Oberoi Realty as well having a good day, 4.5% higher there. Dodla Dairy's results came out today. The stock is off the highs of the day. At one point was up almost 15-16%, but that still trades with gains of around 7%. And Canfin Homes is also reacting to results on the negative side, down almost 2.75%. PSUs are staging a rebound in today's session, and shipbuilders are the ones that are leading the charge. Masgao Dog, Garden Reach signed an MOU today, so a couple of them actually, so 5% there as well, and Cochin Shipyard as well, another 5% upper circuit. The non-shipbuilding PSUs are also having a good day in today's session. Most of the stocks on the PSE index are trading with gains. HAL has snapped a 3-day losing streak. It fell almost 15% in 3 days, up 5% today. BHEL, REC also having a good session today, gains between 3 to 4%. Some stocks moving around on the back of volumes, and those will come up on your screen. Kenplas Samnar is back on that list now, 4.5% higher on strong volumes. Alembic Pharma has been having a good last couple of sessions, was up around 6 to 7% on Friday as well. That's up another 3% today. Atul, after its results, is up almost 6% in today's session on strong volumes, and Chalet Hotels 5% higher today as well. Some stocks that are not doing well within the broader markets, and oil India is one of the PSUs that is bucking the trend in today's session, and some of the other losers as well on your screen. But Oil India is one of those stocks that is not having a good day in today's session.
Okay, all right. It's run up so much so far, right? So some profit booking is something that is on the cards. Thank you so much, Hormas, for joining us as always with that list. Let's talk about some earnings reaction now. Supreme Industries is the first management on the show, reported this decent set of Q1 numbers just a while back. We have Mr. MP Taparia, the managing director of the company, joining us now. Mr. Taparia, good afternoon. Thank you, sir, for joining us today. Well, it's a good set. You have seen a 17% volume growth this quarter. Do you stick to the 20% volume growth guidance that you had given for FY25? And also in terms of pricing, the polymer prices, have they corrected now in the second quarter? What is the trend that you're seeing in prices so far?
We are maintaining still the volume growth of 20% for the company and 25% of plastic piping. And the raw material prices, the PVC price has gone up. Now we are seeing correction taking place. So we remain quite comfortable on the range-bound pricing of polymer going forward.
Mr. Taparia, could you quantify the kind of softness that is being seen from the last quarter to the previous quarter as far as the raw material price is concerned? And second question is, how is the demand being as far as the plastic piping segment is concerned? What is the total contribution it has as a part of the overall top line?
Now, plastic piping business may reach around 8,500 crore. Total turnover of the company may be between 12,000 to 12,500 crore.
Okay. So, as my colleague also asked, how are the demand trends now? Is Q2 so far turning out to be better than Q1? Because now we've started seeing that rainfall come back and no deficit so far. And what about the rural area in particular? Are you seeing green shoots come back there?
Normally, in second quarter, demand from agriculture segment goes down, which is rainy season. But from demand from housing side is quite okay. We anticipate good demand now emerging from infrastructure, especially for drinking water supply and for irrigation purpose. And now we are entering into gas pipe system. So we anticipate good demand growth coming from infrastructure.
Mr. Taparia, the guidance that you have given for the volumes actually comes off quite a strong base. So you're continuing to stick to the 20% volume guidance, number one. Number two, can you give us a sense of what will be the contribution of the value-added sales to the overall top line? Because we understand that you enjoy higher margins over there.
You see, value addition in the first quarter, we have grown by 21%. And overall for the year, we maintain that we will have a 20% volume growth. And in plastic piping division, we will have 25% volume growth. For this year, now we have got several expansions taking place brownfield. So these expansions are taking place month after month. Apart from brownfield expansion, when we opened the account result this year, we announced 3 greenfield sites. Now we expanded to 6 sites. Principal among them is we are putting a new site at Jammu in Kaswa district. We are putting a new site in Malanpur, and we are negotiating land parcel 31 acre near JNPT port. So we will be now working this year on 6 greenfield sites, 5 plastic pipe division and 1 for our packaging division.
Yes, the press release also talks about a lot of capex which is coming on stream, sir. Just wanted to understand, is it all that you'll be doing in terms of capex? You have 1,500 crore rupees capex planned as well. Does it cover all that you told us about, the 6 greenfield expansion plans coming in, or there are more on the cards, something that the street can look forward to?
No, when we say 1,500 crore capex plan, that means commitment we expect to make in this year. All the money may not go in the ground because machine delivery takes time. And last year we invested in the ground more than 550 crore. This year also we anticipate our investment on the ground may be close to 1,000 crore actually. But our commitment will be 1,500 crore. We had a cash balance of 1,245 crore as on 1st July this year. So everything will be done from our internal accrual.
Okay. Mr. Taparia, two questions that I have, if you could answer us. First one, talk to us about the kind of order win that you've got from IOCL as far as the composite LPG cylinder division is concerned. We believe that you have a 2 lakh, LOA that's already been signed. What is the size of the total order and what is the opportunity that can come ahead? And the second question, a quick comment on what our expectations are from tomorrow's budgets. Most of the brokerage highlight your particular company as a key beneficiary of any capex that could come about as far as housing is concerned.
First question is about the IOC. We are very happy on this IOC order of around 235,000 cylinder worth 55 crore rupees. And we anticipate the economy will get further boost in the upcoming budget tomorrow. Government is going to give more incentive for manufacturing. Government is giving more incentive on infrastructure. That you recall very much that on the day the government took over, they first announced new housing construction for poor people of 20 million numbers. And we anticipate the number of housing they construct this year may be more than 20 million number, and each housing additional requirement will give further boost to our plastic piping division. So we remain quite optimistic on the budget which is going to come tomorrow.
Yes, all eyes will be on the budget. Mr. Taparia, last question before we let you go. You have expanded and introduced various new models of chair and cabinet in the furniture segment. You've added around, the total showrooms are around 319 right now. Will some of the capex go in more store additions this time? What is the plan with the packaging segment where we have seen a big increase in margins and this particular segment as well?
We are investing more money in protective packaging division. We are also investing in a new product, cross plastic, in this year. We are also going to expand capacity of cross-laminated film. So in packaging segment also we are going to make further investment. We are actually going to invest in all the remaining 6 segments, also some small money, but major money will be invested in plastic piping division. And as you are aware, we are putting a new division of window where we will be investing more than 150 crore rupees this year. Where we will be making window at 2 sites, one at Kanpur and second at Kharagpur in Bengal.
Okay. Thank you so much, Mr. Taparia, for joining us and giving us details about how Q1 was and what you expect for the rest of the year. Let's now slip into a short break. The management of Supreme Petrochem joins us next to discuss the Q1 FY25 results and the way forward for the company.
CNBC-TV18 because we have 25 years of experience decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for.
Well, you should watch the budget on CNBC-TV18 because we have 25 years of experience
decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget?
Will there be more sweeteners for the middle class? Will there be more put on the table for wealth?